What is going on, guys? Welcome to Stock Talk with Nico Criticos. Today, we are going to be doing some stock analysis for Microsoft stock because this stock is at a multi-year low now. As you can see, the stock is at $354. Today, it was actually at 350, and it has not been that cheap since 2023. So we are at a multi-year low. The valuation has come down a lot. I have 17 shares at $414 a share. And if this stock drops more, I'm going to buy more because Microsoft is one of the most powerful companies in the world. And if the PE keeps going down on this, I'm going to keep buying. So, I mean, the market cap is what, $2.6 trillion dollars. I think everybody knows what Microsoft does, but this company was founded in 1975. So, what are they, 51 years old? Dividend yield of about 1%. And we're going to see what is going on with the sentiment here. Why is the valuation down? And what are the main growth catalysts for this stock? So, number one, intelligent cloud. Microsoft's crown jewel and primary growth engine. This includes Azure, Windows Server, SQL Server, and enterprise support services. In recent quarters, Azure and other cloud services surged by 40% year over year. Astronomical growth. Productivity and business processes. This segment encompasses the legacy and cloud software ecosystems that run modern global commerce. It includes Microsoft 365, LinkedIn, and Dynamics 365, driven by steady seat growth in high revenue per user. This is growing at about 17% per year. Then we have personal computing, the most cyclical segment, comprised of Windows OEM licensing, Xbox gaming, now integrated with Activision Blizzard. The devices like the Surface, that's actually what I have is a Surface Book, and the search and the news. And this segment stays roughly flat or up to low single digits. So, what is driving the revenue and profit growth? The $37 billion AI run rate. Microsoft's commercial AI business has completely defied traditional enterprise software law. Management revealed their AI business has surpassed an annual revenue run rate of $37 billion, which is up over 120% year over year. This explosion is fueled by Azure AI consumption. Enterprises are heavily executing AI inference and training workloads natively on Azure. Microsoft 365 Copilot upsells. Corporate IT divisions are progressively moving up the licensing ladder to adopt Copilot and agentic automation extensions, driving higher average revenue per user. Then we come down to profit expansion versus CapEx depreciation. While GAAP revenue and operating income continue to scale smoothly at about 18 to 20%, profit growth faces a structural transition. Microsoft is spending massively on CapEx, leasing and building out data center capacity at a clip of about $90 billion for this year. And next year, they're expected to go over $100 billion. Because Azure is growing 3 times faster than the rest of the business, a revenue mix shift toward cloud infrastructure combined with the massive depreciation expense from this AI hardware build out will temporarily squeeze company wide gross margins to about 63%. And if we want to get a reference point to what it normally is, we can see that gross margin for this company has normally been somewhere around 68%. And so now we might come down to 63 or 64, which is really not that big of a deal. However, because their corporate headcount has remained streamlined and operating expenses are kept managed, operating leverage allows net profit to comfortably compound in the mid double digits. The unassailable Microsoft moat. Microsoft possesses a multi-layered structural moat that makes it virtually impossible to displace from the enterprise landscape. Number one, high switching costs, the enterprise lock-in. Once a Fortune 500 company embeds its entire data structure, identity management, compliance architecture, and productivity workflows into Microsoft 365 and Azure, the cost, both financial and operational, to migrate to a competitor is prohibitive. It is the ultimate software toll. I guess, maybe to some degree, this is somewhat of a benefit for them, but it's not the end all be all. And it doesn't mean that a Fortune 500 company can't move off of Microsoft products and services and onto another company's products and services. So you got to take that with a grain of salt. The network effect of WorkIQ as enterprises use Microsoft 365 Copilot, Fabric, and Azure AI, their data logs and internal artifacts and automated agent conversations feedback into a unified data layer. This creates an exponential data flywheel. The more an organization utilizes Microsoft's ecosystem, the more context-rich, accurate, and customized their AI agents become, permanently widening the gap against third-party plugins. A unique sovereign balance sheet. Very few entities on Earth can self-fund a $100 billion annual AI capital expansion. Basically, only the Mag 7 right now, the hyperscalers, and that's great and all. So, the 3 year forward projections for fiscal year 2027, justified trailing PE 23, projected GAAP EPS $18.45. Let's see, is that line up with Yahoo's estimates? No, not exactly. So they're saying $18, 18.40 for next year, and this is saying 17.30 this year, then 19.5. So I'm gonna trust Yahoo a little bit more, but this at least gives us an idea. So they're saying 23 times earnings next year. 2028, they're saying it's gonna go back to 26. Keep in mind, right now we are at, let's see, right now we are all the way at, we're at a 21, and normally the stock trades at like in the 30s. Okay, we'll say like 35 is not uncommon. And then, yeah, so between 20 to 35. So I would say 25 would be extremely realistic, super conservative. And then what's more likely is for the stock to come back to like a 30. And then if things get a lot better, get back to normal, and the sentiment is back to where it normally is, which is strong, then it could get to a 35. But for our sake, we'll say like a 30 is pretty realistic, and then 25 is like base case, like where it should come back to almost worst case scenario. I don't think 20 times earnings is sustainable long term for this stock. If you look at the last 10 years, this stock has had ups and downs, but it always comes back to like 35. It always comes back to the 35 range. Multiple times it drops to, let's say, the 25 range, but it always comes back to 35. So I don't see it staying down here for long. And just the other thing you get to keep in mind here is I'm like, okay, maybe their growth, maybe it's more of a mature of a company, their growth is slowing. But guess what? Over the last 5 to 10 years, Microsoft grew sales 14% on average. The next 2 years, they're expected to grow revenue over 16%. So revenue is actually accelerating. And look at the last 2 years. It was 16% the last 2 years. So Microsoft is growing sales faster than they were over the past decade. And then, but you want to compare that, and you want to compare margins. But look at margins. ROI is 28%, right in line with the last 5 years average. And then profit margin is the same thing, but profit margin is actually more towards the top range of this. I mean, we're at a 38% profit margin. How many companies have that? Barely any. So the fact that they have like a record high profit margin and faster accelerating revenue growth, the stock should be at 35 times easily, if not 40 times earnings in a good market in a good macro environment, plus good sentiment around the stock. This stock I'm being, this is like top of the line optimistic here, but everything is in place. Like the financials are there to have it trade at 40 times earnings. It doesn't mean it needs to, but I mean, I would say 35 at 30 to 35 is definitely, that's like reverting back to the mean. So like a 32 or 33 is very realistic on this. I would say 25 is like the bear case almost. Like 25, if it only trades at 25 times earnings by next year, that would be like a bear case for me. So if we take 25 times and they're going to do about what, $20 EPS, we'll call it 19 just to be conservative. That gives us $475 share price. A good amount up from here. But I would say 30 is definitely realistic, maybe like a year from now. 30 times roughly $20 EPS. This could be a $600 stock by the end, I would say in about a year from now. By next summer, next fall, I would say this should be about $600. That's my estimate. So, and you keep going. I mean, they're saying 28 times earnings. Okay. Projected GAAP EPS of $25. So we have those numbers. The EPS growth is fantastic. Net income growth, revenue growth is accelerating faster than usual. Everything is like spot on. Like they're doing like everything is right. Look at I mean the RPO backlog is strong. EBITDA, net income, $125 billion in net income. That's like ridiculous to even understand how much money they're making. Cash to debt is good. Dividends keep going up. Shares outstanding, good. We already checked profit margin and ROI is good. This valuation is just ridiculously low. Um, Price to sales of 8 when it's normally at like 12. Free cash flow yield is decent. It's strong, but it's not as strong as it has been in the past, mainly because of all that CapEx and that, data center build out. So you're getting such a good deal here. 20 times earnings. That's like that's cheaper. I think that's like the same price as the stock market's trading at right now. That might be cheaper than the average, than like just the index fund. The market's trading at 21, 22 times earnings. So the fact that this is let's go on Yardini real quick. I haven't been on Yardini in a while, but let's see what the updates are with this. So this is as of June 23rd, 2 days. This is 2 days old. So Mag 7, here it is. Definitely on the over the past 10 years, this is definitely on the lower side. It could go a little bit lower this year, but Mag 7 is not overvalued at all. And S&P large caps, I would say they're at a healthy valuation. I wouldn't call it super cheap or super expensive. So here's the other thing too. Here's the past 6 months of super investors and their stocks they bought. Microsoft is number one. 37 different super investors, practically billionaires, bought Microsoft stock. And in the past quarter, same thing. I don't know why that's coming up. Microsoft in the past quarter, 19 purchases. Okay. 19 purchases. So, and that was last quarter when the stock was way higher. Now the stock is way cheaper. So just keep that in mind. I mean, that's a pretty big confidence thing for the stock and the sentiment when you have all that money piling into it. So, like I said, if it goes down more, I'll buy more. Otherwise, I wouldn't be surprised if this is the bottom for the stock. And then, like I said, I think the stock's going to be 600 bucks sometime next year. But that is my analysis for Microsoft. Let me know what you guys think down below, and I will see you in the next video.